Hello, I'm Finola from RaaS, and today we're focusing on Ricegrowers Limited, which trades as SunRice and under the ASX ticker SGLLV. Joining me to discuss the 2023 results is Group Chief Financial Officer Dimitri Courtelis. Welcome, Dimitri, and thank you for joining me.
Thanks, Finola. Good to chat again.
So SunRice reported a 12% increase in net profit to 54.8 million on the back of a 23% increase in revenue to 1.638 billion and a 28% jump in group EBITDA. And this beat our forecast, RaaS's forecast. But what were you particularly pleased with in this result, Dimitri?
So, to be honest, Finola, some phenomenal numbers off the top. 1.6 billion, 300 million up on the prior period. The business is very pleased with the outcome and all of the markets that we've grown over the last few years, and just reinforcing the strategic positioning both of Australian rice and our international footprints of the international rice that we supply from and source to, and that's been working very well. And with all the adjacencies in our businesses with Riviana and CopRice and the M&A pipeline and activities that we've developed over the years, certainly starting to come through to the fore. And coming out of the drought and really bouncing back and not really losing the momentum and really building on that. And we find ourselves in a good position where we're getting very happy with the results we've just announced, and the outlook also looking favourable for us into FY24.
And the board decided to lift the final dividend to 40 cents per share, bringing the total dividend for the year to 50 cents per share, making it the highest ever paid by the company. Does this signal that the company is confident of its ability to maintain dividends at this level in the future?
So it was a big step up on last year. So 40 cents last year, 25% increase on that into the 50 cent level. And look, I think that just demonstrates the ability of the board to be cognizant of what shareholders have been asking for and the patience that has been shown by the shareholders, particularly through the drought period. We had a 33-cent dividend per share that we consistently delivered, flexing the payout ratio, because whilst we have a dual class structure, very mindful of what shareholders are after from a growth and dividend perspective. So being cognizant of that fact, the board has absolutely been mindful of obviously taking the solid result that we've delivered into account, the good outlook as well, and making sure that the shareholders are being rewarded accordingly. And we would like to believe that certainly a strong and consistently growing position of the dividend is something we can go after. So absolutely top of mind at the board.
And SunRice also announced that it's acquiring the shares it doesn't own in Trukai in Papua New Guinea to give it 100% ownership. What will full ownership of Trukai mean for SunRice and how it operates in PNG?
So based on the current numbers, it's about a 3 to 4% EPS accretion, just straight off the bat. We've operated in PNG for over 50 years. It's one of our largest and strongest markets. We've got an extremely strong brand up there in PNG under the Trukai flagship brand. So with the change, we now have all of our major subsidiaries at 100% owned within the SunRice Group. So it certainly makes it navigating it a little bit easier without any minorities or any externals, and supplying pretty much all of that rice through our international division and the trading desk up in Asia. We're able to find good quality, affordable rice into that market, and that acquisition has been paid by local debt facilities because keeners have been difficult to extract out of PNG. So we've utilized local facilities to fund that transaction, and then over time we'll recycle that with some non-core assets that we have up there. So makes sense, certainly reinforcing the position we've got in the Pacific, and of course in a very big market for us, and made that business grow from strength to strength. We're also very proud of the positioning of the brand over time.
And the company's commented that the strong revenue momentum experienced in 2023 is expected to continue into 2024, although at a more moderate pace. Can you comment further on the outlook for FY24, Dimitri, particularly in relation to the recently harvested rice crop and the recovery in a number of the group's divisions and markets?
Yeah, so we bounced out of the draft. So FY21 to 22, we put 300 million over the top of the prior period. We've done that again. So we've grown the business from 1.3 to 1.6. The reason we chose that wording in the outlook is so that the market doesn't take another 300 and add it on top. But we certainly expect our business to grow at a top line level across the group. We've got some exciting initiatives both in the outer markets and of course across the retail segments in Australia. And when you look at our subsidiaries with Riviana and Courtelis, the strength of the brands, the developments and the synergies that we're now extracting in our M&A's activities that we've acquired over time with KJ & Co. in Riviana in particular, and then of course Pride's Equine in Courtelis. It's really starting to step change the face of the business away from that pure agri focus in the past into a more global FMCG player. And with that, hoping to unwind that discount and start trading at a more healthier multiple, moving away from a pure bulk play that we were in probably 10, 20 years ago. So with that step change, really driving that FMCG focus and again, depths in existing markets, but also new market share around the world. We've got a UK FTA that's recently been agreed. So that's an opportunity in terms of a market that we're looking to explore. With Europe as well, whilst they're quite dry at the moment, they're experiencing pretty bad drought periods over the last year. So that's another area that we're looking to focus and capitalize on and provide some supply into. But in our existing and more established markets, again, very strong brands across Asia, across the Middle East, which are big markets for us, and North America with our Californian segment under Sun Foods. So really capitalizing on the strength of the brands that we've built up over time and the depth in those existing markets, and then of course across ANZ as well. And on the back of the inflationary environment that we are obviously finding ourselves in, it's that brand resonance that is helping to maintain price and space on shelf as well. So we're quite positive with regards to the outlook, both at top line and bottom line. We're working on a lot of initiatives to help reinforce that. Yes, headwinds in terms of inflation, supply chain disruptions, but that's starting to ease a little bit in terms of what we've seen in the last few months. So hoping that a more normalized position in FY24 where we can really extract the value and continue with the momentum that we've built up over FY22 and particularly in FY23.
And Dimitri, working capital is a significant swing factor in SunRice's business, or can be. Could you give us a sense of the likely movement in working capital over the next 12 months and how this will impact on net debt?
Sure. So yes, working capital is directly a function of our Australian crop. That's the biggest driver in there. So as we flex back into a large Aussie crop, we tend to see our seasonal facilities really utilised for that purpose. And we finished FY23 with a lot of inventory coming out of the Australia position, which is good because that just means we're able to fully service those markets and all the operations in the Riverina fully utilised and earning their share of overhead recoveries and really helping to keep the system in equilibrium. So we'd expect that to normalise over the next 12 months because we are sitting on a lot of Australian inventory that will then monetize over the course of the next 12 or 18 months. But that's, again, just a part and parcel of our business model. And that's why we've called out our net debt separately from a seasonal and a core debt perspective, because core debt facilities are only used for M&A activity and accretive acquisitions, with our seasonal facilities funding working capital requirements, which, as I mentioned, is heavily driven by the Australian crop. So as the Australian volume bounces around and increases, so will that seasonal requirement. But yeah, we're looking like we're heading for another at least 2 years of a substantial Australian crop. The water system is above 90% full, so we can expect a solid FY24 planting, which will then be marketed in FY25. So what that means from an investor perspective is you're really looking at least 2 or 3 years ahead of us, where we are in an Australian crop position with the whole business or the equilibrium really maintained, enabling us to go after a whole bunch of opportunities, both locally and internationally, and really expand the depth of our other segments and extract that value. So we really are building the momentum and looking to convert that in the coming year.
Well, thank you, Dimitri, for joining me today. I'm looking forward to checking back with you on SunRice's progress over the course of the next 12 months.